The reason is simple. We create new tools to manage risk, but those tools inevitably generate more risk. The 1998 long-term capital management crisis was caused by massive leverage using derivatives to hide risk, which then led to a contagion when Russia defaulted and LTCM's trades imploded. That crisis was resolved only by the Fed engineering a bailout. But the bailout in 1998 meant that Wall Street learned the wrong lesson. It could take any risk, as long as the Fed was there to bail it out. Today, Wall Street's biggest banks are even bigger, and their dependence on derivatives is even greater. And there's no one to bail them out when the next crisis hits. Jim Rickards, the renowned economist, discusses the escalating danger of financial crises and their potential to surpass the power of the Federal Reserve. Focusing on the years 1998 and 2008 as critical turning points, Rickards highlights the crucial role they played in revealing the vulnerability of global markets. Drawing from the past, Rickards explains that the 1998 crisis originated from Russia's default on external debt, triggering a worldwide liquidity crisis. As markets spiraled out of control, the crisis eventually reached long-term capital management, LTCM, where an accumulation of $1.4 trillion in derivatives led to staggering losses of approximately $4 billion. This severe liquidity crisis exemplified the domino effect, where panic selling spread contagiously, leaving collateral worthlessness and triggering margin calls that forced desperate investors out of their positions. Jim Rickards further examines the 2008 financial crisis that unfolded with the collapse of Lehman Brothers. He reveals that other major financial institutions, such as Morgan Stanley and Goldman Sachs, were also on the verge of failure during this time. The domino swaying effect had set in motion, threatening to bring down the entire financial system. Yet, the Federal Reserve stepped in just in time, using emergency measures to mitigate the damage by halting the cascading collapse of markets. Rickards emphasizes that each rescue effort mounted by the government becomes more colossal than the last. As crises grow exponentially in danger, he advises investors to seek refuge in assets that will remain immune to a global liquidity crisis. These safe investments include land, real estate, precious metals like gold and silver, and valuable items such as fine art. Rickards points out that even fine art, like Andy Warhol's iconic Marilyn Monroe painting, has undergone steep appreciation to an estimated worth of $200 million from its original 1970s price of $50,000. For those interested in stocks, Rickards suggests focusing on companies grounded in natural resources, such as ExxonMobil and Chevron. He warns against relying solely on a traditional stock portfolio, as the upcoming liquidity crisis is likely to heavily impact banks and money market funds. Rickards raises an interesting observation about the dollar being a cryptocurrency since 1979, when the Treasury stopped issuing paper Treasury notes. He notes that the currency has been digital and encrypted since approximately 1980. However, despite its digital nature, he foresees potential risks and cautions against underestimating the impact it may have on the economy, highlighting the significance of second and third-order effects. With each word, Jim Rickards effectively communicates the urgency of the impending crash, warning viewers of the criticality of taking precautionary measures. By providing historical context, insightful observations, and valuable recommendations, he equips his audience with the knowledge needed to navigate the treacherous waters of future financial turmoil. Over-reliance on certain tactics can diminish their impact, especially when used indiscriminately. It becomes a case of crying wolf, where the targeted individuals or entities become desensitized to the measures taken against them. An example of this phenomenon is the current situation in the global financial landscape. In the past, freezing a central bank or ejecting an entire country from the Society for Worldwide Interbank Financial Telecommunication (SWIFT) system was unheard of. However, we now find ourselves witnessing these unprecedented actions. Take Russia, for instance. The recent freezing of their central bank and expulsion from SWIFT is a prime example of the escalating use of such measures. Rather than accepting the consequences of their actions and adapting their behavior, the affected parties seek alternative solutions. They choose to abandon the existing dollar-dominated payment system and explore new avenues for financial transactions. Even influential figures like the Saudi Arabian princes are considering this shift. Consider the scenario where a prominent Saudi prince, such as Mohammed in the Salon, decides to venture beyond conventional markets. This individual is accustomed to a luxurious lifestyle, boasting properties in Monaco, Aspen, and various palaces and yachts worldwide, not to mention private jets. However, this opulent existence could be jeopardized, similar to what we have observed with Russian oligarchs. The actions taken against them serve as a warning, indicating that their assets could be seized. These instances of power flexing are not limited to oligarchs alone. Even countries like Canada have witnessed a form of modern-day fascism. Christian Freeland, Canada's Deputy Prime Minister, resorted to freezing the bank accounts and cryptocurrency wallets of truckers, going as far as criminalizing support for the truckers under a recent interpretation of Canadian law. This extreme measure indicates a troubling trend where authorities infringe upon personal liberties. These developments should serve as a reminder that anyone seeking to trade and invest in global markets should exercise caution. It is crucial to build a portfolio using a reliable and comprehensive investment app. Such a platform provides access to stocks, ETFs, options, and more, all within a single interface. The process is simplified and streamlined, ensuring a hassle-free investing experience. In a startling turn of events, Canada and the US, both major players in the global economy, have taken the drastic step of freezing the accounts of individuals they deem unfavorable. While some argue that there may be valid reasons behind these actions, such as the case of Putin's invasion of Ukraine, it raises concerns for those with substantial assets, like Saudi princes, Russians, and Chinese oligarchs. The question that arises is, how secure is the dollar in such a volatile climate? Speaking from personal experience, I must say that I am an astute observer. However, if we look at Larry Fink, for instance, who has spent most of his career in academia or government, it becomes evident that he lacks a comprehensive understanding of the real world and the issues we are currently discussing. This lack of understanding leads to a failure to grasp the intricate workings of the international monetary system and the potential repercussions that can arise. Allow me to illustrate this with another example that has garnered significant attention. When the US imposed various sanctions on Russia, the latter retaliated by halting the export of strategic metals, chemicals, and other essential elements required by other nations for their manufacturing processes. One of the exports banned was nickel, a crucial component in the production of batteries, particularly for electric vehicles. As a result, the price of nickel skyrocketed, increasing 4- or 5-fold. The London Metal Exchange, unable to cope with this sudden surge, had no choice but to close its operations temporarily. These instances serve as clear reminders that actions taken within the international financial arena can have far-reaching consequences. It is essential for decision-makers to possess a deep understanding of the interconnectedness of global economies and the potential blowback that can occur as a result of their actions. Failing to comprehend these dynamics can lead to unintended outcomes, causing disruptions and instability within the financial system. Jim Rickards examines the repercussions of the ongoing economic war between Russia and the United States. While both nations are vying for power and influence, it is interesting to note that it is a Chinese billionaire who suffered a significant loss. This unexpected turn of events highlights the unpredictable nature of such conflicts. The Chinese billionaire in question had invested heavily in one of the largest nickel mining operations worldwide and lost approximately $5 or $6 billion. This outcome was not foreseen by many, including the billionaire himself. It serves as a prime example of how the damage can manifest in unexpected ways during an economic struggle. Jim Rickards goes on to discuss the gold reserves held by Russia and China. He reveals that Russia possessed around 600 tons of gold, which has now soared to a staggering 2,300 tons. Similarly, China's gold reserves have increased from 600 to about 2,000 tons. However, it should be noted that China might have even more gold stored away, potentially several thousand tons, but the exact figures remain undisclosed due to the opacity of the state administration of foreign exchange. This exponential increase in gold reserves by Russia and China aligns with the warnings issued by the Pentagon in 2009. It appears that both nations have taken heed and followed the recommended strategy of bolstering their gold reserves. However, this accumulation does not automatically secure any country's dominance or reserve currency status. Contrary to popular belief, the Chinese yuan will not replace the US dollar as the global reserve currency. One of the main reasons behind this is the absence of a robust yuan bond market. This market is essential because it represents the currency of the bonds that countries invest in, rather than physical stacks of $100 bills. China's yuan bond market is currently underdeveloped, illiquid, lacks primary dealers, trading infrastructure, auctions, and settlement clearance. Moreover, the absence of a strong rule of law further diminishes the yuan's appeal as a global reserve currency. Nevertheless, Jim Rickards suggests a feasible alternative. He proposes the creation of a new currency that incorporates all the necessary attributes for a reserve currency. In his example, he outlines a system involving a Swiss bank, UK law, and a third-party depository for gold. This replacement currency would require establishing trust and confidence, which China currently lacks. Despite the potential for a new currency, China's current deficiency in bond markets makes it highly unlikely that the yuan or repo will replace any existing reserve currencies. In conclusion, the ongoing economic war between Russia and the United States has unexpected consequences, as seen in the losses suffered by a Chinese billionaire. Russia and China have both significantly increased their gold reserves, as warned by the Pentagon. However, China's yuan lacks the necessary infrastructure and rule of law to become a global reserve currency. Jim Rickards proposes the creation of a new currency that addresses these shortcomings, but for now, it remains a hypothetical solution. To learn more, click the link in the description and make a deposit to claim your free stocks.